Hi, good afternoon, everybody. I hope you're all having a great week. We're stepping up our audio-visual game this time. I hope you like it. We are filming from the studios at the Conservative Partnership Institute just off of Capitol Hill. Let me go through a couple things real quick, just housekeeping items. You know the routine. First off, please make sure you mute your audio if it isn't already. And check your name on the screen to make sure it's correct. If you're showing your phone number, please hover over those three little dots, click rename, and put your name in there so that we know who you are. As always, this is the legal disclaimer. The Club for Growth Foundation's mission, as always, is to educate the public about economic freedom and limited government. And for this episode and going forward, sound money. We are not here to discuss elections or anything political. As in the past, this is a 60-minute Zoom call. Feel free at any time to pose questions in the chat section. When the time comes, I'll try to call on as many of you as possible. And remember, you don't have to write out the full question. Just signal in the chat section that you have a question, and we'll be sure to call on you. So with that, let me introduce our guest. She's Judy Shelton. She's a monetary economist and a senior fellow at the Independent Institute. She's previously been associated with the Hoover Institution, the Lehrman Institute, which actually has ties with the Club for Growth way back when, and the Atlas Network. She was an economic advisor to President Trump before Trump eventually nominated her to the Federal Reserve. Her nomination was eventually blocked by senators who were, appalled by the idea of sound money and stable prices. You can see her regularly, or at least often on CNBC, where she lends her expertise on monetary policy. And her Twitter handle is @JudyShell. Judy, how are you today? Where does this podcast find you?
I am at home in Fredericksburg, Virginia, and doing very well. Very happy to be with you.
Well, thank you so much for joining us. Let's just address the big question right off the bat. The CPI came in at 5.4% 2 days ago. That's the kind of inflation we haven't experienced in a long time. Can we dispense with this transitory idea? And what do you see in the months and years ahead?
Well, I'll just say at that level, this is a political problem for the Biden administration. People notice that level of inflation. And it's a policy dilemma for the Federal Reserve. Certainly they're in charge of maintaining price stability, but their tools are not really geared for this kind of inflation. So even as they start the taper, which they are broadly hinting they're prepared to do, I would still expect 5% or more inflation well into the first quarter of next year. So it's hardly proven to be transitory, because people are already feeling the pinch, especially on groceries, gasoline, rental, furniture, all the things that really affect the quality of life and the burden of having to budget.
There was the running joke about how, the Washington would say there's not going to be any inflation at all. Then they moved to it's going to be transitory. And now they're starting to say, well, a little inflation's good. The key in my mind is, what happens when it starts hitting wages? When everything is so now more expensive, we've got labor shortages. What happens when people at the end of the year are sitting down with their bosses and saying, you need to give me 10% more because of what's going on? What's that going to do?
Well, it just turns into a vicious cycle. We've already seen that Social Security is going to give a cost of living adjustment of 5.9%.
Oh, that's right. Yeah.
So then that gets embedded. It's kind of sad. A lot of people may say, look, at least the government does these COLA adjustments, so I'm better off taking government transfer payments or being on the dole in one way or another, because it probably would be a while before my employer would say, look, let's just see if we get back in business, if I can get enough people to come to work, and then if I can make a profit, then we'll see about raising your salary. So it really complicates the whole dilemma. So far, the inflation is running ahead of the wage gains. So people have a net reduction in purchasing power.
So talk to me about this taper plan. And for everybody that's on the call right now, the Fed right now, and correct me if I'm wrong, Judy, but the Fed right now is buying $80 billion worth of treasuries every month. And then on top of that, they're buying another $40 billion in mortgage-backed securities. And so the taper, as I understand it, means that they're going to buy 70 billion or 75 billion of treasuries and 30 and 35 billion of mortgage-backed securities. And then they're just going to slowly reduce those numbers. That means the market, actual people, have to come in and start buying those things instead of the Fed. And they're going to demand higher rates, right? So the analogy I've always heard is that it's like trying to catch a falling knife is what the Fed's about to engage in, and things could get pretty crazy, right?
Well, I mean, what you say is the way open market operations are supposed to work. I mean, it used to be that the Fed at the margins would buy or sell a few Treasury securities. Now it's a lot more complex. And I mean, these are not like the same mechanisms that were useful to Paul Volcker in the 70s.
Right.
And we can get into some of those details if we want to talk about the rate the Fed pays on reserves kept by banks and what they're now doing. But you're correct on those numbers. I'm quite sure it'll be reducing it by 15 billion a month. So it'll be from the 120, it'll go to 105 and then to 90 and then to 75 in the same percentages, as you say. It used to be 80 and 40, 80 treasuries and 80 of the mortgage-backed securities. And that'll rough out at 8 months. 8 months of doing that, you'll be into the middle of next year. And then the next big question is whether they pull out the big gun if inflation hasn't really been affected by the tapering, which I don't think it will be very much affected by the tapering. Interest rates on treasuries might go up a bit, but I don't think that's going to affect the CPI very much. So then we'll see if the Fed feels compelled to raise the rate they pay banks not to make loans.
Okay, that's interesting. So I want to prod that a little bit. And I know this is a kind of an esoteric issue, but by them tapering and treasury rates going up, you don't think that will affect the CPI numbers? Talk about that a little bit more.
It's because, for one thing, that is not contractionary monetary policy. It's not tightening. It's just a little less stimulus, which even that word doesn't really apply anymore. When the Fed normally would be reducing interest rates using quantitative easing, think of the way the model is supposed to work. As you lower the cost of capital, assuming that the Treasury rate is the base for the entire array of increasingly risky investments like loans that banks would presumably be making, if the cost of borrowing, the cost of capital goes down, then that is supposed to incentivize companies to invest in the kind of plant and equipment that would allow them to expand production, because now it's cheaper to finance that as a capital investment. But that whole idea is that by enlarging their capability to increase output, they'll then feel pressure to get the employees to apply the human capital to the technological increased capabilities. And so it's all based on the idea that this will create more jobs. And the reason that was considered a bit of a risk of in terms of inflation, the trade-off, the Phillips curve trade-off, if you get the higher employment, but then you'd be risking the inflation, because all those workers would now be getting higher wages because of the increased demand for labor. And then that would ultimately figure into an increased demand for consumer goods. And then up goes the CPI because of the demand pressure. But what we're seeing, and again, so the Fed is set up to do things like that when it cuts the interest rate so low. But the problem is not creating those jobs. That's not our problem. It's filling those jobs. So what the Fed's continued purchases have really accomplished, I think, is it's just really served big investors because they can borrow at this cheap margin rate and invest it in the market, which is flourishing. It has helped big government for sure. We see the Fed buying up government debt. In the last 2 years, they bought enough to cover the deficit, half the deficit for the last 2 years, 2021. And I think it also helps big business because a lot of the cash has allowed them to buy back their own shares. I mean, it's cheap money, but it has not really expanded productive capabilities that would lead to an increased supply capability in the private sector. And so now I think the inflation we're looking at is really much more the result of the fiscal policy than the monetary. The monetary has sort of stayed corralled because the banks sell their treasuries to the Fed and then they keep the money locked up at the Fed. $4 trillion.
Because they're getting interest on that, on the reserves. Yeah.
Consider this. It's up to 4.2 trillion in reserves, none of which are required. There are no required reserves anymore. So the way you learned about how monetary policy works in college doesn't apply. The discount rate doesn't matter. The reserve requirement doesn't exist. And so that 4.2 trillion, that is the entire amount, a record amount of revenues collected by our government this year. That's the new numbers for 2021, the fiscal year. 4 trillion, more than that, is now just sitting at the Fed. All the revenues collected by the government. So that just tells you that banks have learned to be very comfortable leaving the money sitting there, huge volumes. They get a very thin margin, but they don't have to do anything. They don't have to do anything. They don't have to hire loan officers. They can shut branches. So I think the Fed is training banks not to make loans to the private sector. And so how are you going to, by increasing the rate you pay banks to do that, how are you going to ever get them to want to make the loans that could potentially enlarge the capability of our economy to increase output, to relieve the demand side pressures that we're currently experiencing?
Yeah, this is probably a good time to mention your Wall Street Journal op-ed that you wrote 2 days ago for everybody that's on this call. Google that, or we could send it after the call. But you basically described a lot of just the contortionary efforts that the Fed is doing to basically centrally command the economy. Did you want to go into that a little bit and all the gimmicks that the Fed is doing to try to manage this economy from up above?
Well, I thank you for mentioning that. It has bothered me for a long time, and especially when you hear people talk about the needing to preserve the independence of the Fed. The Fed is really compromised. It buys the debt. I mean, Treasury, one agency of government, creates the debt, which is necessary to cover the deficit spending by Congress. And then it briefly goes to the primary dealers who can turn around, and the banks know they can sell it to the Fed because the Fed is just standing there ready to buy that debt. And indeed, they proceed to do so. So they enlarged their balance sheet, 3.3 trillion. It's now about 9 trillion in assets the Fed has. And they let all of that go to maturity. If anything matures, they don't get paid principal, they roll it over. So that is just a permanent source of financing for the government. And we are now at the point where of the debt held by the public, which is the debt on which Treasury must make interest payments, is owned 24% by our own central bank, another agency of government. So the Fed not only owns a quarter of all the debt of the government, but it takes the interest payments that Treasury pays on that debt owned by the Fed, turns around and gives back virtually all of them. It takes out what it pays on reserves. So we're already going to affect the interest rate policy of the Fed, because that would be deducted from this amount that is otherwise returned to the Treasury, that is to the American people. And so you have a Fed that just, it occurs to me, why not have the Fed own all of the debt instead of just 24%? Why not own all of the debt? Then the Treasury would pay all of the interest payments to the Fed, and then the Fed would turn around and give virtually all of them back to Treasury. And so then you see, when you take it to that extreme, which is becoming less of an extreme, given how much there's no limits on how much Treasury debt the Fed would be allowed to purchase, you see what a Peter paying Paul setup it is. And I'm just trying to bring light to that financing. I think it would bother Americans to consider that that's how we're financing our reckless spending.
Well, I think exactly what you're talking about is why, half the people in the media treated this $1 trillion coin idea credibly, when I suspect most of the public thought this has to be a joke, right? And, Yellen kind of eventually poo-pooed the whole idea, but it was astonishing how much credence it got in the press.
Well, and from Paul Krugman, writing in the New York Times.
And maybe I'm getting ahead of myself. Do you want to explain the $1 trillion coin idea, just so that our audience knows what it is if they don't already?
It's the notion that Treasury, which has the right to mint coins. I mean, we see commemorative coins. You can buy gold and silver coins. Let's say if gold were at $1,800 an ounce, where we are roughly, and if Treasury mints a coin using, let's say, $1,000 worth of gold, they would sell it for much more, maybe $1,500, and then they would print on it, this is worth $50, because the idea is no one would ever use, it is legal tender, but no one would ever put that into the system, would pay for $50 worth of groceries with a coin that costs them $1,500 and has $1,000 worth of gold in it. This would be something quite different. Treasury can also issue a platinum coin. I don't know why they choose platinum, but it's because it's allowed as a precious metal. And they could put a notional or a nominal value of it of $1 trillion. I mean, much more. It could be worth, I don't know, $200. I don't know. Depends how big it is. And then the idea is that they would then deposit that at the Fed, which is a fiscal agent for Treasury, and the Fed would have to accept it at that nominal value, whatever's printed on it, because that's its legal tender value. First off, no Fed chair worth their salt, I think, would even accept that. Doesn't mean it couldn't happen.
Did Jay Powell ever say anything? I'm not sure I saw him say anything about it. Did you?
I haven't. From our Fed chairman, I didn't see him say anything. Janet Yellen finally, after the Washington Post had a story saying this was considered in the White House as a possible option. And by the way, Krugman justifies it by saying, oh, well, the whole debt ceiling is just theatrics. Therefore, let's do something theatrical, such as the $1 trillion coin. And she said, no, I'm against it. I think it's a gimmick. But then she proceeded to define a gimmick. And she said this would be like having the Fed just lend money to the government, and it would conflate monetary and fiscal policy. And I think that was the final spur to me to write out what do you think is happening now? Because if that's a gimmick, then I think that's exactly what they're already doing. And so I wanted to illuminate the way that part of monetary policy works to offset the interest expense of the government, because the money Treasury remits, these remittances show up in the Fed's annual income statement. And by the way, it's even a higher percentage of their total operating income. It's like 98% of their operating income. So it's the 102 last year, the 102 billion they made off their portfolio, less a little bit they have to pay on interest, less very, very minor administrative costs. And then they were virtually handing all of their income back to Treasury. But it counts as revenues to the federal budget, as revenues. So that's to me, the kind of outrageous part. I mean, it would be funny if it weren't so sad, because I think it shows the sorry state of our hand-to-mouth finances. And I feel morally a government owes its people sound money and sound finances.
Well, I want to talk about the solution here in a moment, but let me wrap this part up. What does inflation do to the Biden agenda? I almost feel happy with inflation high, because doesn't it kind of put the kibosh on Biden's big spending plans? I mean, I know you're a monetary economist, but if you have 5 to 10% inflation, does that not tell the politicians in Washington that we can't crank out $3 trillion proposals anymore? I mean, what happens in that regard?
Well, I would certainly think so.
We would think so as normal people.
I mean, yeah, I think it's logical that if you are increasing demand with further payments, and I saw today the Treasury put out a statement about how much they're putting out for child tax credits that were part of the COVID response, and then saying, oh, and if we end these in December, oh boy. I mean, the point being, transfer payments have really increased, and we saw how many people got loans that turned into grants without too much paperwork, and we've seen the unemployment increases, and all of the transfer payments that have come from our central government, and now you have cash in the real economy. We already had excess cash floating around, what I'll call the play money in financial markets, the kind that gets into the reverse repo arrangements with the Fed, where you trade cash overnight to earn 5 basis points. So that money is doing nothing for the real economy. But the real economy made up of people who actually work. That's where the demand has increased, because people have piled up cash in banks, and then they're writing the checks, they're using their credit cards, they're buying like crazy. I mean, even if you're locked at home during COVID, you can order things from Amazon, and people have been ordering a lot. So to foster increased demand through a fiscal measure, as being proposed by the Democrats at a time when we have not even come close to resolving the supply issues, to me is the absolute worst prescription, the worst policy you could be pursuing.
Jared, our producer here, I'd like for him to put up this tweet by Michael Berry. Hopefully you can see it on your screen. There it is. Michael Berry, if the audience is not familiar with him, he's one of the folks that invested heavily and made out handsomely during the 2008-2009 financial crisis. So a lot of people look to him to see what his views are. He believes that inflation is going to be absolutely fierce, and he wrote this tweet. He writes, "The Fed, by insisting inflation is transitory, freezes companies from offering much higher wages that may become permanent, thereby creating more inflation through shortages, worker shortages, union strife, and now create an oil spill." That oil spill thing seems a little egregious, but what do you think about this overall idea about how, what I take away from this is that the Fed is paralyzing the economy?
Well, I think that's an interesting take. And from a textbook point of view, maybe it would make sense that an employer would be having this discussion with the worker and saying, the Fed says it's transitory, therefore I don't want to give you a wage increase because then I'll be stuck. You won't want me to reduce it in the future if it turns out that inflation isn't with us. And so meantime, I've increased the nominal wage I'm paying you, but it's not really worth it in terms of a real economy that has settled down. I don't think those conversations or even that thinking occurs in quite such a direct way. I think right now you have employers who are just scrambling and almost willing to pay whatever it takes to get the workers. The unions, I don't know how much they're insisting on wage gains for whole unions, thousands of people at a time that are looking that far into the future. Maybe they're looking for a cue from the Fed. But I understand his point that if the Fed says it's transitory, then maybe the employers would be reluctant to give the increases. But as I say, meanwhile, if the government is all in and giving COLA increases that are even higher than the current level of the CPI, then I think you're just setting up a situation where everyone is conscious that unless they get theirs, unless they get their particular wage increase, they're going to be net losers because they see the prices of groceries and gasoline and housing going up.
We've got about 10 minutes before we start taking questions. So, fellows, everybody in the audience, please put a question in the chat when you're ready. I want to tackle two more issues. One is, what about this idea? It seems silly to even suggest it, but what do we need to get back on the gold standard? And is there any appetite anywhere to make that happen? I know that's something that you believe in, and it would return some soundness to our monetary policy. But what do you think?
I have to say that when you reference a gold standard, you really have to define what that means. And I guess I've been saddled with everyone's whatever interpretation they think would be most damaging for whatever reason. But it's not as if, well, I'll just put it this way. If people think a gold standard means that, a dollar can be traded in for gold, just for practical reasons, Treasury owns maybe at 1,800 an ounce, 261 million ounces. I don't know, that's going to be 400, less than 500, less than half a trillion worth of gold. And the Federal Reserve alone has 4 times that amount in banknotes that have been issued, just paper money, 70% of which is outside the United States. So, I mean, there's no, I don't think anyone's advocating that. When I've talked about a gold standard, what I've said is we should learn from prior monetary systems. The gold standard, that the classical international gold standard, one thing great about it was effectively a common currency. It was a stable platform for free trade, and you couldn't have depreciation of currencies because every country had to be willing to convert its own currency into gold at a fixed price. And in that sense, governments were really bound by needing to have balanced budgets. If people thought the money was too many notes were being issued by a government, given the amount of real value in the economy, then at the margin, they did have options for converting. You could take some banknotes and convert them into gold, and that would slowly start to recalibrate the amount of monetary claims to the economy relative to the real value of the economy. So you had kind of a self-equilibrating mechanism there. A different sort of a gold exchange standard was under Bretton Woods. People say, oh, we were on gold until 71. Well, citizens weren't of the United States or anywhere else, really. It was foreign central banks could take dollars and redeem them from the United States for $35 per ounce of gold. That helped in terms of keeping the dollar fixed relative to other currencies. And after World War II, that was set up in 1944, that provided, again, this very solid platform so that goods traded at fair price instead of countries manipulating their currencies, depreciating them to gain a trade advantage. I'm very much against that. And it also helped direct capital into its best use. So it helped rebuild countries that had been devastated by World War II. When I talk about what could be happening in the future involving gold, I look at maybe setting up some kind of Treasury trust bond, I would call it, some kind of instrument, make it a 50-year bond that would be linked to our gold holdings. It would be like a TIPS bond today. You have inflation,
Treasury inflation protection.
Treasury inflation bonds that compensate the holder for inflation after the fact. And some people would say it's not the inflation I worry about so much, it's the purchasing power. And I think gold is a commodity surrogate. And so I would like something that would compensate me for a change in the value of the dollar relative to gold. I mean, it would be an interesting instrument. And if people wanted to purchase that, then I think you could see private financial companies duplicating that sort of investment, that is combining a traditional treasury security with a gold futures contract. And other countries could do the same. Ultimately, you would have sort of a pseudo gold standard in that if the European Central Bank was willing to issue a bond where so many euros were convertible into an ounce of gold in so many years, and the U.S. had something similar, then you were at the same time inherently fixing the rate between the dollar and the euro. I think that could be interesting, but again, you have to define what you mean by a gold standard or by utilizing some concepts from prior regimes that did have gold play a role, and see if we can. I mean, you could even apply this in the cryptocurrency world. Sometimes, you could have this instrument offered by Treasury, and that could be a stable coin, effectively it's like a currency board arrangement, where if you issued a stable coin, call it a solid U.S. dollar, and it was 100% backed by these sort of securities, that could be a very interesting stable coin that would let the U.S. still have a leadership role in the international monetary system, but I think one that would benefit everyone in terms of getting us back to a more solid platform for trade and for individuals, a more sound money-based approach.
I'm glad you brought up the stable coins because, as the fellows know, I'm kind of a fan, or at least a follower of the Bitcoin idea. And the whole premise behind Bitcoin is separating the state from monetary policy. Because if we did want to return to something like a gold standard or some of the things you suggested, there would have to be the political will to do that. I think what Bitcoin is proposing is this idea that politicians cannot be involved with monetary policy at all, so that there's no endless wars or unfunded entitlements. The sky's the limit on all the things that the biggest supporters of Bitcoin suggest. What's your view on Bitcoin? And then once you talk about that, let's end with central bank digital currencies, because that's like the evil opponent to Bitcoin. I kind of see Bitcoin as Superman, and CBDCs are like the Bizarro, if anybody understands that analogy.
I think I do. I'm very sympathetic to the whole alternative currency movement, and I think Bitcoin. I think a lot of these competitive currency ideas and now reality were prompted by 2008 and being victims of the mismanagement of money and credit in the system. I don't know how the Fed escapes responsibility. There's no institution that would have more capabilities to properly calibrate the amount of money and credit in the economy to the needs of that economy than the U.S. Federal Reserve. So it's interesting to me that the Bitcoin idea is based on mining. It's like gold in the sense that, you know, some people say, well, why would you mine gold just to bury it or whatever? It's why would you have weaponry if you're never going to use it? Why would you go through the effort to mint Bitcoin, which takes real effort? I mean, Bitcoin is based on that idea that there is a value in each unit. I think that we're going to see the government come down harder. We're already seeing it. The first attempt to badmouth the alternative currencies was to insinuate that they're used for criminal purposes, as if those banknotes I spoke of earlier are not used, those $100 bills are not used for criminal purposes all over the world. They certainly are. I think we're seeing this friction with the SEC, although now we're going to get an exchange-traded fund. I guess that Bitcoin will be, you can purchase that way. What we've seen is people are interested in an alternative unit of account, one that would transcend borders. They're interested in a new medium of exchange or a secondary or just an alternative medium of exchange. As far as store of value, for me, the problem with Bitcoin is it's made money for people as an investment versus it can be used as a medium of exchange. But I look for something maybe a little bit different. I'm watching it. One thing it has proved is that if people decide to use a different currency, it's going to be very difficult for the government to prevent that. And but I think they will try. I think they will certainly try. And without legal tender status, no alternative currency can possibly compete with the dollar in the long run. I mean, if you're going to have to pay capital gains based on what you paid for the currency and when you used it, and have to track all that, and have the IRS track all that, they can certainly discourage the use of alternative money.
So speaking of the government tracking you and monitoring what you're doing, central bank digital currencies are all the rage now. You see China doing it, but China's got this social rating system where, you know, if you jaywalk, you get docked a little bit, which means you're not available to get a prestigious job for your family or all sorts of things. But one tool that supposedly the Communist Party can use is digital currency, where they can surveil your transactions. They could tax your transactions. They could censor your transactions. For instance, you know, if it was adopted here, the government may say that having a subscription to the Wall Street Journal is no longer allowed using digital currency, but you can subscribe to the New York Times. I know that sounds a little far-fetched, but like that's the capability, the technological capability of a central bank digital currency. And lawmakers and bureaucrats on Capitol Hill are seriously talking about it. What's your view on this, and what's the end game? Is it inevitable?
Well, I spoke with a number of senators at the time I was going through the nomination process who are quite interested in the idea of a central bank digital currency issued by our Federal Reserve, because they saw China moving ahead quickly, and they thought that China would be wanting to displace the US dollar, and that maybe with all the bells and whistles of having a digital currency, since that seemed to be the way the world is going, we certainly wouldn't want to be left behind. The problem is, I personally wouldn't be comfortable. I would not trust the Federal Reserve to set up private checking accounts for people where they did all their payments through the Fed. Because what we've seen, look at the European Central Bank. They impose negative rates on the banks that are required to have depository accounts there. If you had a Federal Reserve that decided that in order to properly stimulate the economy, they would go to negative rates, that means your deposit could have money just confiscated from it. And you thought you put in this much, but the Fed then says, yes, but you only have this much you can spend. And that to me is such a violation of private property. That's expropriation. I think we have that even by having built-in 2% inflation, let alone the inflation we're getting to now. But just the idea that the government would issue money and deliberately depreciate it 2%. Let's say you just put that money under your pillow and you earned it. I mean, that represents private property to you. And to have the right to, without due process, expropriate a portion of that. And over 10 years, it adds up, or 20 years. Think what it does to the value of a house. I mean, inflation is insidious, even at low levels. So as we've seen, and as you explained very well, China uses that kind of technology to even more closely monitor people. And we need to start going the exact opposite direction. And I think we've seen a huge negative response to this idea of the IRS having even more invasive powers to see what you spend money on. So I think people are turning away. The Fed will come up with something, but as I say, let's make sure they don't use that to stamp out the advancement of alternative currencies in the private sector.
Yeah, and your point about inflation being insidious, it's remarkable how inured we've become to like 2% inflation, as if that's harmless, when in fact 2% over several years is just devastating to savers, or to everyone, in fact. Let's get into questions. Jonathan Jakubowski from Ohio, you've got a question. Go ahead, Jonathan. Are you there, Jonathan? All right, let's move on, unless you're going to pop in any second. All right, how about Rick down in Texas, Rick Barnes? Are we having technical problems? I knew we wouldn't get away with this perfectly like we are. Why don't I just ask Jonathan's question? He asked, what's the best resource for understanding the root causes of today's crisis and how to move forward? Do you have any suggestions on that?
That's pretty broad. I'm not sure. You mean monetary policy?
I would think so, perhaps. Or I would be more interested in like understanding the labor shortages and just the paralysis that's occurring right now.
I think I don't know of any textbooks, certainly the ones that I've used in the past to teach graduate courses in money and banking or in international finance. They just don't apply anymore. The Fed conducts its interest rate policy. Primarily, their main instrument is being able to raise or lower the rate they pay banks to keep the money sitting in a sterile Federal Reserve depository account. That is so different from the old way of buying and selling bonds. That's now a side thing they do, I think, to finance government for the most part. But they don't change the discount rate. As I say, they don't have required reserves at all. So the main tool is very, I used to study the Soviet economy. And the banking system was really just a way to channel credit to the central government and to carry out the central government's economic plans. So I think you have to start reading more contemporary essays and podcasts and just kind of discovering for yourself. I don't know a textbook on all this. My own one, Money Meltdown, came out in 1994. I don't think I've changed very much as far as saying what sound money really does for an economy and how that can be undermined by monetary policy. But I don't have any ready text to recommend.
Hey,
Jonathan,
Andy, this is Jonathan. Judy,
yeah,
can you hear me?
Jonathan? Yeah, go ahead, Jonathan.
We weren't allowed to unmute, or it wasn't allowing us, so now I'm good to go. Thank you for answering that. I think I'm more looking for like a podcast or a resource generally that taps into these issues. And to Andy's point, the question's pretty broad, yes, but it's monetary, it's fiscal, there's labor shortages, there's a whole lot of stuff going on. So I was curious if there's a place that I could go that's regularly talking about this that you would view as a trusted resource. And then just real quickly, on the point that you made about transitory inflation not affecting the way employers view labor, I would concur. I'm a small business owner. We're rapidly growing and desperate to find labor. And I don't care what the Fed's doing about transitory inflation. I just want to find people to fulfill the roles for us to continue operating. So just a quick add on to that. Thank you.
Well, thank you for confirming that. I mean, you guys are the real heroes to me, and you're doing whatever it takes to make your companies work. So I can only imagine how hard it must be to want to get back in business and then have these shortfalls of labor and then see prices going up on inputs. You're in a tough situation. Again, I tell you, as soon as I get off, I'll start figuring out a good place to recommend. I probably always start with the Wall Street Journal. Yeah. I think their take is pretty good on these issues. It is a changing situation for sure. And as I say, the old rules just aren't applying anymore. I even worry that if the Fed breaks out the big gun and let's say before the end of next year raises that rate that they pay banks to keep the money sitting there, if the banks are keeping $4 trillion there now, getting peanuts, if they hear that rate's going up, aren't they more incentivized to just keep collecting that? I mean, in the fall of 2019, after rates had been raised 9 consecutive times, before they took back 3 rate increases in late 2019, those banks were getting 2.4%. Think of that. I mean, you know, just if they increased the current rate 10 times and they got up to 1.5%, that would be, you'd think, huge. The banks might even keep more reserves there. And when the reserves are there, they're not going into the real economy. That's why I think the Fed has avoided inflation until now. That money has stayed corralled at the Fed. The money supply is a function not just of base money, but of velocity. And velocity is, you get that through the multiplier effect. When banks had reserves in the old days, they couldn't wait to lend them out because they got nothing. They got nothing from the Federal Reserve. And so, of course, they wanted to make money. And that changed when we had the emergency in October of 2008. The Fed was given the power to pay interest on reserves, I think as a way to make banks whole, but also because they were afraid that all the quantitative easing, which is also part of the reaction to the 2008 financial collapse, it was clear that that could be hyperinflationary potentially. We'd never done all that QE action before. And Chairman Bernanke at the time wanted the ability to stop inflation in its tracks. And about 3 years after they were given these emergency powers, he said on a 60 Minutes interview, I can raise interest rates in 15 minutes. So people who are worried about inflation, he said, look, all I have to do is pay banks more not to lend. And then it all collapses because then you don't have velocity and the money supply goes back to being just a force that doesn't really affect inflation. So this is too powerful a tool the Fed has now, and banks have been very comfortable with the way it's operating. They're making money from fees, from credit cards, from mergers and acquisitions. They haven't been making the loans. And if you look at the bank portfolios through the years since 2008, you'll see that a much smaller percentage, less than half now, less than half of their portfolio represent commercial loans to the private sector. And that number's going down even more.
Just to weigh in on Jonathan's question as well, besides the Wall Street Journal, one thing I do, Jonathan, is I have a Twitter list of all people that I respect and listen to when it comes to this sort of thing. So go into Twitter, go find at Judy Shell and several other people I can give you recommendations to. Put them in your Twitter feed, and then just check that every day. I think that's a great way to stay up to speed on all this. Okay, we got less than 10 minutes. Yeah, we've got less than 10 minutes, and I want to get two more questions in. Rick from Texas, you're back on. Are you there?
Yeah, I'm here. I appreciate this conversation. I think this is good. And I don't want to make it political, but I do want to talk about the current administration a little bit. It is one thing to disagree with them. It's another thing to absolutely not understand them. And in the issue, early on, you were talking about the issue of labor, and I think labor in and of itself is a huge problem. But this is also coming from an administration whose belief was all we have to do is raise the minimum wage to $15 and we'll fix everything. And we still have a serious problem. I think today the issue is those who are working are having to work twice as much to make up for the fact that they're only half filled, the positions. And I just don't know where this administration is coming from with anything they're talking about in this, and just wondering what your reaction is to that. Who's advising this administration? What's their long game plan? And in the end, is it just we have to suck it up for 4 years and fix it then? Or what's our immediate reaction to it at the labor level?
Well, I think we all know the Keynesian approach has always been that it's the nominal, not the real. I mean, Keynes thought that you stimulate an economy through monetary policy, basically that the inflation allows you to reduce the real cost of wages under the illusion that people see a nominal increase. Maybe they see their wages go up 3%, inflation's 4%, so you really cut back the real cost of what you're paying, but they don't know it. So what I mean is the same people who say, oh, all you have to do is raise the minimum wage. There's an assumption that people are kind of dupes for money illusion, that they think if you, it's kind of like all goes back to $1 trillion coin, that if you put a value on something and you stamp it and say this is what it's worth, including labor that maybe isn't worth $15. I mean, if you say that for entry-level people who want to get their first job and develop some good work habits, but it really isn't worth it, they won't get hired if the employer has to pay that, then you're cutting off a whole segment of people learning to develop good work habits. And now that there's such a demand for labor, again, I think this administration just has the wrong approach. First off, I'm anti-big government. I think private sector solutions are always to be preferred. I think limited government is a blessing, and they're going the other way. I thought the pro-economic growth policies of the Trump administration, so we'll call those Republican, but in particular, the program of cutting the corporate rate, cutting income taxes, reducing the regulatory burden, increasing our energy capabilities, and I think confronting trade partners like China who cheat. That's why we got the good economic performance, especially in 2018 and 2019. I mean, even now, seeing these revenues come in at the record $4 trillion level for fiscal year 2021 tells us that those reducing the rate ended up bringing about more income. So I think the policies that are now reversing almost all of those pillars that I just went through are damaging and discouraging. I agree with you on that.
All right, we got 3 minutes left. Nick from Alaska, the great state of Alaska, are you there? Why don't you ask your question? I think a couple of fellows thought what you had to ask was a good one.
All right, thanks for giving me an opportunity to ask this question. So what are your thoughts on the implications of stable coins to facilitate payments? And in your view, do you think stable coins represent a net threat or an opportunity to the U.S. consumer?
For me, an opportunity. As I said, I'm very interested in stable coins. Now, I look upon the concept as a coin that is linked to, takes its value from an underlying currency, fiat currency, but let's say the dollar. And it operates like a currency board, which is effectively 100% reserves. The threat would only be if there's fraud. I think if someone is using a stable coin that they thought was issued only because those reserves were backing it, and then it turned out that it was all an accounting scheme and they didn't have the reserves, then, that's something different. But I think the concept is very interesting to me. And I hope it goes further. I mean, I don't want to see restrictions on it. I'm interested in all of these, and I'm watching to see how they're going to get through SEC resistance, Treasury resistance, and probably the Fed has some issues on financial stability, because if that's contributing to what they see as the monetary base, then that does have implications for trying to control monetary policy. But I kind of trust that development is more gold standard-like to me, in that it gives power to the individual to decide if they want the currency or if they want to convert it back into the asset behind it. And I think that helps calibrate the money supply to the needs of the economy better than 8 FOMC meetings a year.
It does seem like the stable coins could be the free market alternative to a central bank digital currency, but that is up to the good folks in Washington, D.C. to decide. But with that, we're out of time. Judy, thank you so much for doing this. Your expertise on this issue is very appreciated. I think a lot of people do glaze their eyes over on monetary policy, but I do believe that it's going to be absolutely fundamental over the next 1 to 10 years, or who knows how long, but it's going to finally be an issue that people are going to have to learn about. So thank you very much for doing that. Thank you very much for coming on, and we look forward to hearing from you again.
Thanks for the discussion and the great questions. Appreciate it.
You bet. And for all the fellows, I think we have our next call on November 4th. I'll send you out all the details. I think I already have, but that's with Chris Wilson, who's going to talk to us about school choice policy. So thanks, everybody, and we'll talk to you again soon.